Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and impact. I'm Govindraj, Ethiraj. Today we look at what lies in store in 2015 in two parts. First, let's try and understand what are the business and economic challenges ahead, both internal and external. In the second part, the only way to perhaps attack some of these issues is the budget. And the budget 2015 is something that people are going to look at very closely. Let's try and understand what the strategy could be or should be in order to address some of the larger issues that are facing the economy. Joining me, Joshi, Chief Economist of CRISIL, and Rathi, Director with the Aditya Birla Group. Gentlemen, thank you very much for joining us. Let me begin with you, Mr. Joshi. So we're looking at let's look at the two broad swaths. One is the internal challenges and one is the external challenges. Some things have changed since we last met, so to speak, as we go into 2015. So there is an air of optimism. But is that air of optimism sufficient to take us through the larger challenges that we are facing and meeting the growth targets that we want to meet?
Well, I think from the external front, I think the last year was a year of uneven recovery, and we'll see the same thing this year. Actually, it may become even more uneven. Because
and why do you say uneven?
Because some parts of the world are growing, others are not.
Okay.
Like Europe, the growth is very weak. Japan is in recession. China growth is slowing down. US is the only beacon of hope right now. I think it's growing much faster than was expected. So now what the oil price decline has done, I think it's going to favor some countries. IMF, for instance, has estimated that 30% decline in the price of oil lifts the advanced economies' GDP by 0.8 percentage points. So that's going to be good for them. But what happens to countries like Russia and others which are oil dependent?
Yeah, or some of the Latin American
Latin American countries, and even the Middle East, where we export a lot. I mean, that so if lower oil prices mean lower GDP growth, lower demand in these economies. So some good news, some not so good news. I think on balance, I would say the situation globally would be similar to what it was last year, except that we as an import dependent economy, particularly of oil, we are going to benefit much more.
So that's the external. So okay, so let me get a business view. Mr. Rathi, as someone who's part of a large global conglomerate, how are things looking for you for 2015? I mean, how is it all stacking up?
Definitely the things are improving, but I think the economy will not grow by itself. It has to be, the growth is to be driven, and the key factors will be, I think, the continuation of reform agenda. So as I see the things, while the things look better than 14 in the coming year, I think first 6 months will be very critical. We'll have to carefully watch what are the steps government is taking to continue with its reform agenda. And that would include allocation of natural resources and issues like land acquisition bill, issues like insurance, how they take final call on these things. And plus, we often try to overlook the reforms which are needed in the direct taxes, and eventually, they drive the investments and they drive the industry quite a lot. So I think I am looking at government's steps which will be taken to push the economy forward.
You talked about taxes. What is the one or two key areas where you feel that things need to get moving or need to be cleaned up?
See, whenever we talk, we always talk of modification of the laws and things like that. Yes, we need, well-defined tax laws. But more than that, I'll consider the execution part of it and the administrative reform part of it. Today, you see, while there may be minor issues or one or two major issues when it comes to international investments, a lot of problems are related to administration of the tax laws. We don't see clarity there. We saw, a lot of confusion being built. Let me give one example. Look at the enormous amount of tax law cases which are pending at different levels. I think it will cost more than 3 lakhs or so. And if you look at the litigation amount involved, it will be more than 2 lakh crore. Now, with when we are aspiring for a huge growth, when we are looking corporates to push forward the growth, we can't have this kind of confusion prevailing in the direct tax laws. And one single item.
I'll come back to the sort of economy and tax part in a bit. But let me ask you, I mean, for you as a group, as the Aditya Birla Group, a significant part of your revenues and profits come from global operations. Now, how is that looking for you? I mean, is that, are things on an even keel as, when you look at the mix of your operations in other countries plus in India, or is there an imbalance, and if so, where?
Govind, let me confess, I'm not so very close to the overseas operations as much, But all the same, I can tell you our Indian part at the moment is looking much better, both in terms of growth of capacities, in terms of capacity utilization, and as well in terms of revenue growth. But yes, I think we are doing fairly well on international front as well. But our domestic part to me looks far more promising in terms of growth of revenue as well as profitability.
Mr. Joshi, let's come to the internal part for a moment. And there are 2 or 3 things that have been of concern and have been raised on various occasions and platforms. So interest rates is obviously one. The slowdown in manufacturing is the other. Some people link the two or try and link the two. And there are other problems such as flexibility of labor markets and so on. What could be the sort of succession of issues that could be looked at or ought to be looked at?
Well, I think it's hard to say that what should be done first or how, but I would say the 3 key issues in the domestic economy which are not sorted out as yet. We have sorted out some of them. For instance, inflation is now on a very comfortable position, so to say, and also growth is inching up.
And let me ask you a quick question on inflation. Have we sorted it out or did it sort itself out?
Well, I think it's not. It didn't happen on its own.
Okay.
I mean, so oil was just one factor
Yeah.
that was good luck.
Yeah.
But you should also give credit to RBI for staying put. I think at least managing the expectations, and government also contributing by ensuring that they release food grain stocks or they were very restrained in MSP increase. I think those are the steps that government took to ensure that inflationary expectations and inflation remains.
So that is one. Okay.
That is one. So it's not. I think it's not just luck alone.
Okay.
I mean, there has been some proactive action. So that is one part. And then the growth has. I think if you look at if I draw a chart of growth from 2012-13, it seems to be inching up 4.5, 4.7. Now this year 5.5, hopefully, and next year crossing 6%. So growth inflation dynamics definitely improving. But what has not improved is manufacturing, number one. I think it has since 2011, manufacturing sector has been just wobbling around a very, very low average rate of growth. I think which is
almost close to zero.
Almost close, a little over zero, but I think very big source of concern. The second, I think, is the private investment. Private investments have suffered the most in the last 6 to 7 years, and they have fallen from a peak of about 17% of GDP to now close to 10.5% of GDP. So very sharp decline in private investment. And then the third is right now the private consumption itself is not picking up, which is visible in the weak demand for a number of consumer goods, etc. So I think from the data I would be looking at what's happening to the private investment cycle, what is happening to manufacturing, is there a durable lift coming in manufacturing or not, and the third is private consumption, because if private consumption doesn't go up, your utilization levels will not go up.
Right. And so let me put that question about private investment to Mr. Rathi. Mr. Rathi, from your perspective, what's holding back private investment and as a corollary to that, private consumption?
I think Mr. Joshi has articulated things very well, leaving very little for me to be said. See, the key issue today is the manufacturing growth. It has suffered, and if you look at it, I think we are at 2011 level, if you look at the overall data. Now the question is, how does it pick up? We have a lot of ideal capacity. I think I'll first bank upon if the consumption goes up or if the demand goes up, then we can enhance our capacity utilization. Once we reach a optimum level of capacity utilization, then only we'll think in terms of new investments. So I think manufacturing now is basically looking at utilization of its current ideal capacities, which is there in almost every sector. And the second aspect will be, okay, the fresh investment thereafter. Now, he made a mention of interest rates. Somehow I always have a contrary view as compared to the, economist in general. I think 1% here and there is not going to make a sea change to the manufacturing growth. We have learned to live with little higher interest cost, that's secondary. The key issue will be policy issues where we want clarity and we want speed there. Second would be the demand growth, and then we'll look at capacity utilization increase, and then comes the question of fresh capacity. So I think it's a multi-step process. It's not going to just happen just like that.
So, Mr. Joshi, so demand consumption is something, it's something that is worrying a lot of people. And, even people I talk to, for instance, they can't understand. Demand seems to be actually falling out of the flow, or I mean, it just seems to be getting dissipating for reasons unknown. Why is that?
Well, I think one of the reasons why private consumption is, by the way, about 60% of India's GDP, and the two reasons for that. Initially, I think high inflation was contributing to lower demand for discretionary items, because when you have to pay too much for food, then you have not too much left for spending elsewhere. That was one part. But I think the other part is the income visibility itself has gone down. I think unless people see their incomes rise, or they are not going to exercise discretionary spending power. I mean, which anyway has reduced. So I think it's a vicious cycle. I mean, how do you revive it? So one way to revive typically is through fiscal and monetary stimulus, which we don't have much ability.
Yeah,
to
we are
do.
actually withdrawing excise duty cuts.
That's right. So now I think the only way we can do it is through structural measures, which I think, which is one word for it is reforms. I mean, whether it is ease of doing business, whatever you have. Through these measures, when you try to do it, it's always a slow process. That is why I think even with this, even with the new strong government coming in, and even with few steps taken here and there, I think the growth revival is extremely slow and has not taken place at all in manufacturing. So it's going to take time before it picks up.
And I'll come back to manufacturing in a second, and industry as well. What about agriculture? I mean, how is that looking, particularly in terms of fresh credit flow, or change? Do you see any changes in the overall jobbing patterns that you've been writing about a lot?
Yeah, agriculture is, I think, this year has not been a good year because of the bad monsoons, but I think it's still driven largely by monsoons, because we look up to the rainbows every year. But apart from that, I think agriculture performance as such for the last decade hasn't been too bad. I think it's just that I think the demand has risen too fast, and I think we've not been able to sort out the logistics issues, etc. That is why I think food inflation has remained high. And in some cases, I think where you need to focus is milk, for instance. I mean, though the consumer price inflation is down to 4%,
milk is rising. Yeah,
it is rising. It's actually at double digits even now. So it's something which has become very sticky. So there are these pockets within agriculture which need to be sorted out, where from an inflation perspective you need to pay more attention to, where the demand is rising too fast. You have enough food grains. I think there's enough stock, but I think you don't have enough proteins in the economy right now.
Okay, that's a good point. And let me get a last view in, Mr. Rathi. Again, if you were to look at the 2 or 3 points that for you will matter the most as industry in 2015, what would they be?
One will be, the clarity on the various policies. Second will be allocation of natural resources. We have a lot of confusion there, be it allocation of land, or be it allocation of coal mines, or whatever it is. And third, of course, would be ease of doing business in India. You see, today now, putting up a project is a nightmare. If I want to put up a cement project today, it will take me almost 4 to 5 years, which used to be 2 years earlier. So I think ease of doing business will be another very, very critical thing. The one point which has not been possibly touched upon is a poor state of affairs of PSU banks. What you see, what you read, I think is not even half the story. There are a lot of NPAs hiding in the PSU banks, and that could have all-round impact on the growth if not managed and handled correctly. And the corollary to that is, highly leveraged balance sheet of corporates. If you look at the debt levels, they are, astonishing in few given cases. So I think these are the key factors we like to narrate. And if you want to take forward the economy, a push will have to be given by government on many of these things which I listed earlier.
Right, Mr. Rathi, thank you so much. And Mr. Joshi, last word, your 2 or 3 key sort of points that you would like to see addressed.
Well, I think I would.
You talked about private demand. You talked about private consumption.
These are symptoms that we'll look at. I think developments in the economy. But from the public side, government side, I think I would like to see mining activity pick up pretty soon, because that's the lowest hanging fruit according to me. And then second is, I think I would like to see GST being pushed. I mean, it has been diluted a bit, but at least if it is pushed, I think it will create a very positive environment.
Right. We've run out of time. We take a break here, but coming up on the other side, we talk about Budget 2015, since that's the one policy response, or the major policy response we have to some of the issues that we've talked about, and what could be or ought to be the strategic overview driving the Budget 2015 exercise. Stay with us. Hello and welcome back to Policy Watch. India's banking system is under stress. As we all know, many bank balance sheets need capital, but so does India's private sector, India's corporate sector, which needs to grow. The other big question is, of course, Budget 2015 and what is the strategic direction that could be set or ought to be set in order to meet India's growth aspirations. I'm now joined by DK Joshi, Chief Economist of CRISIL, and BD Narang, former Chairman and Managing Director of OBC, to discuss this. Gentlemen, thank you very much for joining us. Mr. Narang, I'm going to come to you in a moment. Mr. Joshi, tell us what's the, there is the budget, and right, there is a whole list of, the Dobie's list that everyone has about what they want. But what is the strategy that you're looking out for? What is the direction that you're looking out for?
Well, I think one critical thing that the budget has to do is, I think it has to reform itself. I mean, in the sense that the expenditure mix of the government now needs to change, and decisively change. Which means cutting down subsidies. We've been very lucky that oil subsidies are going to have been very low this year, and next year also we are going to benefit from that. The oil subsidy is taken care of. We have already had reforms there. It's only petrol and LPG and kerosene are left. I think that probably government should initiate. But the larger other issues are the big elephant in the room is food subsidy. How you're going to address that issue, and the fertilizer subsidy, which is, I think, which also in dire need of reform, so to say. So I think that there can be a lot of saving. Number of studies have shown that if you rationalize food subsidy, target it better, I think there are savings to the government, and you have better targeting, benefiting population at large.
Right.
So I think that is one aspect. The second aspect is fertilizer. I mean, fertilizer, the urea is so subsidized that the excessive use of urea has reduced the fertility of the soil. It has impaired the crops. So I think there are many negatives that we are seeing. So you need to address these two issues also in the budget. So once you do a permanent fixture of these, then you release resources for spending elsewhere, which is a productive spend. And the capital expenditure has been has been dampened quite a bit, so to say, in the last 2 to 3 years, because because you wanted to maintain a fiscal deficit target and you could not garner enough revenues, you were reliant on cutting expenditures. I think that you need a permanent solution so that that doesn't happen again. The only way to do it is to rationalize spending, so spend less on wasteful expenditure, more on productive, and for that you need bold decisions. So it has to be
right. And let's talk about the productive part in the investment. Mr. Narang, couple of points. I mean, so one is, what in your mind, what is the reason that the economy has had such sort of stressed assets? I mean, very broadly, I mean, I think we know all the specific ones. And secondly, what do we need to do at this point of time in order to sort of make the banking system more healthy, in order so that it can serve the purpose of fueling some of the growth that we are all talking about?
I think what you are asking is basically, how do we start the investment cycle from the banking point of view? I'll answer your question in a very precise manner. Why there are so much of NPAs? One was infrastructure sector. We all know they are extremely long-term assets, 15 to 20 years of age. As chance would have it, I was chairman of the committee which introduced funding norms for infrastructure. Banks were supposed to appraise and then present those appraisals before the long-term funding agencies, or finance them and later on sell them to the long-term funding agencies. Unfortunately, the report got accepted, but it took 15 years for the government to evolve norms for sort of a takeout products. Now then, what the result was that during all these 15 years, whatever infrastructure loans banks gave, they got stuck on the books of the banks. They couldn't unload them in a manner and at a cost or at a price at which they ought to have been unloaded. 2. Banks are overexposed to power sector, IPPs, distribution, and all other related agencies connected to power. Now, banks can't take that kind of a load. There have to be a specialized long-term funding agencies to take care of the funding requirement of all these sectors. So is the case of the shipping. Now, that was one reason why. Then the unfortunate part that came was the real estate sector. Anything and everything connected to real estate, be it a real estate development, be it a hospitals, be it a tourism related projects, they got stuck on the books of the banks. Meanwhile, there was a bit of depression, they couldn't service their liabilities. And third was the commodity sector, that is the steel and coal. You all know that steel has gone through very, very rough time, and mining added to the problem. The cost of the iron ore proved to be much more than anywhere else in the world, and our entire steel sector became unviable. Fact of the matter is, most of the steel companies are in actual operational losses. I don't know how do they manage to show profit, and if they have one, where is the inventory coming from. But fact remains that both real estate, power, infrastructure and steel added to the problems of the banks. And most of these should have, in ordinary course of business, been funded by institutions other than banks. So is the case of the Indian Airlines. Now let us understand the issue of the corporates. Our corporates are over leveraged. If you look into the ratio of the capital of the corporate to the total outside liabilities, at times it is working out to be 2 to 3%. I don't want to name the groups, but the leading Indian industrial groups, their ratio of capital to total outside liability is less than 3%. In ordinary course of business, they ought not to be less than 10 to 15%. That means they have to strengthen their balance sheet very badly. Now, government has to come down, RBI has to come down, government has to come down, the industry has to come down with norms that beyond this, no corporate will be allowed to approach a bank, they should approach a capital market to borrow. They may have to pay extra price, fine, but that is what the market economy calls for. So they need to strengthen their balance sheet. So at the end of the day, what is a problem? The problem is, on one side is the asset quality and on other side is the rate of offtake. And the reason is the poor quality of the balance sheet, both of the bank and as also of the corporate.
Right. So, okay. So, let me come back to you with a question in a moment. Mr. Joshi, how do you see this situation, right? So, you've talked about some of the challenges on the expenditure side. This is some of the challenges we have on the capital side. What does this add up when it comes to trying to divine a strategy that we should be taking when it comes to a budget policy document?
Well, I think budget has very limited ability to infuse capital into the banking sector. I mean, banking sector,
needs.
Which definitely needs.
Yeah.
I think what they can do is definitely dilute the stake of PSU banks. I mean, to still have the controlling, and that will release quite a bit of capital. I think otherwise, I don't see how you will recapitalize the banks at this juncture. And without financial sector being healthy or the banking sector being healthy, it's a major source of funding for the economy even today. And without that, I don't think the economy will be lubricated for higher rates of growth. I think it doesn't have the ability right now.
Right. So, Mr. Narang, so there are, I guess, one or two parts to it. So, one is the health of the public sector banks and, recapitalizing them and so on, which the government might be able to do, assuming there was a more aggressive divestment program. The second is, of course, the health of the companies to whom the banks have lent. Again, if you were to look forward in 2015, using maybe the budget 2015 exercise as a starting point, how would you expect or like things to be handled from here on?
There are very limited number of options available, but now I'll address both these issues. First is the banks. I understand that Government of India under the present dispensation may not like to go below 51%. Understandable. There are political compulsions, fine. They don't have to hurry up. But what can they do is to encourage banks to strengthen their balance sheet is to provide aggressively. For example, the standard provisioning on standard assets can go up from 40 basis point to 100 basis point. That will create enough cushion for these slippages. And how the banks can be helped is, let these 1% provisions against standard assets be made tax exempt. Means today the tax exemptions are available only if account is written off, not if there is a standard provisioning. If this much of assistance is made available, number of healthy banks will opt for increasing the level of provisions and creating a cushion in their books of accounts, and definitely they will be able to meet the challenge. That is issue number one. Issue number two, corporates. As I said earlier, we don't have a lack of entrepreneurs in this country, and their ability to digest, internalize technology is one of the highest in the world. The real shortcoming is the capital strength. We don't scrutinize where from the capital is coming. In fact, most of the capital that is coming is diversion from the working capital from the sister companies, and we just don't question that. But what today we can do is, we have entrepreneurs, we have ideas, we have a small capital to begin with, but we don't have. We have to encourage private equity or venture capital to step in. That means we have to aggressively incentivize private equity and venture capital throughout the world to come and put shop in India. This can be done. Today, India's story is acceptable to the whole world. They are ready to come. And if they just imagine, if they take up 5 to 10% of the industrial corporates, the whole cycle can immediately start with. Just by encouraging venture capital and private equities to come and do business in India. Today you will be shocked if I tell you that Indian banks also cannot put money into the venture capital. They have to make a provision of 150% of the total investment made. Similarly, REITs can take over the role of the banks. REITs, R-E-I-T-S. They can take over the role of the banks. Some money can come from the banks, some can come from the private investors, some can come from the international investors. So that immediately will start the cycle up. So there is no, I am not that pessimist that nothing can be done. Things can be done, but we have to go in a very sort of determined manner. Third, the government of India last time made an announcement, they will start with a venture capital.
Right. Let me interrupt you there for a moment, Mr. Narang. We're running out of time. Mr. Joshi, what are the one or two haves, must do and must not do in a budget exercise in this context? Well,
I think in this context, I think the budget, first of all, has to have a fiscal deficit target which is reasonable, and within that, how it manages without any creative accounting, how it, in a clean manner, how it manages to address these issues. I think that will have to be seen. I don't see budget as an instrument of addressing the banking sector issues. Sure. But I think definitely, but I just wanted to add to that, it's not, we should remember that it's not the lack of finance alone which is impairing growth in the economy. I think unless the non-financial factors are set right, I don't think no matter how much finance you have, it's not going to work. Whether it is ease of doing business, whether it's availability of power, land laws, labor laws, unless these are sorted out, just pumping capital will not help.
Right. So and that's really a strategic direction.
So it has to, both the things have to move together. Right now, I think unfortunately, because of the stress in the banking sector, its capability to finance higher growth is impaired. But I think the root causes of all this is, I think, the regulatory risk that arose in whether it is infrastructure or manufacturing or wherever it was.
So a composite policy must account for this. Absolutely. The soft side of doing business in India as well as the hard side.
Absolutely.
Right. But you're saying capital itself is not so much of a challenge. So we need to fix the problem of stress.
Yeah, I think if you fix the other problems, the capital will also come from other countries.
Right. We've run out of time. Thank you very much, Mr. Joshi. Thank you, Mr. Narang. That's all we have time for on Policy Watch this week. We'll be back next week, same time. Thanks for watching.